Hello and welcome to Forbes India Pathbreakers with me, Neha Bothra. My guest on the show is Karthik Reddy, the co-founder of Blume Ventures. Today we talk to him about the craft of the venture capital business, how the startup ecosystem has evolved, and what it takes to make a mark in this area. Stay tuned. Karthik, so good to have you on Pathbreakers.
Thanks for having me, Neha. Excited.
I want to start by going back to 2010. That is when you set up Blume Ventures.
That's
right. The first venture capital firm in the country to have been 100% raised by domestic capital. Tell me a bit about the conversations you had with limited partners at that point. I asked you this question because venture capital was a relatively new beast and private equity was the talk of the town. So how did you convince investors to put in money into Blume Ventures?
So it wasn't easy. Eventually, we won them over just by appearing as nice guys, giving it our best shot. Therefore, it materialized only when somebody either took a gut call, as we do on entrepreneurs, or there was high referenceability. So that process was tiresome. We probably pitched 600 people and got 75 yeses. People say 1 in 8 is not a bad ratio, but it is tiresome. The checks we got were really tiny. So if you wanted a 100 crore fund, which is what we wanted, there was a lot of adding up of checks. But to your original question, I think the concern was people didn't understand 2-3 things. They did not understand, which even today is not fully proven. How can something go from 0 to 10 in 10 years flat? So you're essentially selling the idea of a 10-year fund. And you're saying you'll invest in kids or young entrepreneurs or seed companies, which are not yet off the ground. And so that cynicism, skepticism still exists because we haven't proven that necessarily. That we can build a profitable or an exitable or an IPOable company in a 10-12 year time frame. And that was a concern even back then. Second, India was a tough market. Right? It continues to be. And then the last thing, whatever said and done, you can say you're an early stage venture fund manager. You can say you're here to change the world along with your founders. Fundamentally, when someone gives you capital, they see you as a money manager, are you capable of generating returns? And then as a money manager, you tell them the formula in venture is that you lose most of your bets. So unfortunately, you have to, you'll take the naysayers, criticism, and prove that the model works. And thankfully, we're grateful to those 75 odd people who gave us those 100 crores. And then we never looked back. So that's how the journey started.
That was Fund 1, and now you're operating out of Fund 4. So
that's
over
right.
these years, the average ticket size of your checks has also doubled with each fund.
Yeah, it's a good way to put it. Yes, you're right. Yeah. I think the two phenomena for that. One is, as a first-time manager, even now I think, you feel immensely responsible for the capital you've taken. So your risk appetite for how much you can absorb as a loss is almost as important as the greed of how much you can make. So everyone thinks we can build $1 billion company, but at what cost if things don't work? That's a calibration of risk that takes seasoning of some kind.
Yes.
Right? To lose $2-3 million is incredibly painful. Back then, to lose 1 crore was incredibly painful. Right? And so now you'll say, what about 1 crore? And you basically realize the market has moved. Why is that? Because you've recalibrated what the outcome size can be. 10 years ago, if you had asked me, can you imagine multiple billion-dollar companies in a single portfolio? I said, no chance. Now it can happen, right? I have 3 in single fund. Yeah, I haven't delivered the exit, so that'll happen. But I'm just saying, the fact that that could happen in a single cycle is what gives us confidence to take that additional risk. But the idea of losing capital is daunting, whether that's 1 crore, whether it's 1 million, whether it's 10 million, right? And therefore, you wanted to diversify risk. The interesting other element is, the thing you left unsaid is, valuations have gone up from $1, $2, $3 million. Valuation. Check size is becoming that large at a $10, $15, $12 million. So it's almost like things have expanded 4x or 8x. So to your point, that's exactly the check size expansion and inflation you need to get the same ownership. So basically, the combination of us wanting to own more, having a larger fund, so having the ability to write a little bit more risk at this inception, and valuation, you can say, why does valuation grow? Because valuations in venture are a determination of where the next round will be, what the exit outcome is possible, and we work backwards. So the confidence that in Levin was, if it gets to 100 million, it's a fantastic outcome. Today, people are dreaming 2 billion. That's a 20x inflation in the dream. Not many will get there, but you're able to hopefully deliver a few of those, and that pays for all of the risk you took. So you add all of this math up and suddenly we are writing, as you rightly said, up till 2015 December, which was the beginning of Fund 2. Blume had never written a starting check more than 250,000. For 4.5 years, we managed with that. Then, like you rightly said, we went to 500K to $1 million. Then we went to 750K to 2 million in Fund 3. And now, on average, we're writing 2 million plus. So what happened? So I think it's a combination of just having confidence, seeing it play out. And the other interesting phenomenon is somewhere in 18, if you've noticed, we've started raising capital for the winners. We wanted to go deeper in them. So there are actually 4 or 5 companies in the portfolio where Blume alone has played $10 to $20 million in a single company, but over 6 to 7 rounds. So when you have already absorbed that kind of risk taking in your head, it recalibrates and says, okay, you can take $2 to $3 million of capital risk. So then you start getting courage that you know how to pick better. Only time will tell whether we deliver. And I've made sure that we keep that promise of telling you also through mega files.
I'll come to that in just a bit. But as a money manager, as someone who's betting on entrepreneurs at an early stage, the entire craft of venture capital, which is the one part which makes you happiest?
I think the last one. I think as a firm, what obsesses us most is making entrepreneurs win, right? And also therefore sticking to our knitting and only doing early stage. Because you can't get that win in any other part of the risk curve. There you become a money manager and you become a capital multiplier. We want to be that as well. But if that's a singular motivation, I'd rather do late stage. It's much lesser work, arguably for much more capital under management. What drives us, as idealistic as it may sound, that we want to fund the change we want to see in the world.
You do have a lot of exposure to agritech, climate tech. You have a lot of these companies in your portfolio.
And that is definitely a motivator, right? It's not simply, oh, there's hot money in crypto, or there's hot money in AI, or the gaming or betting or whatever. That hasn't been our drive. In fact, a lot of these hot things we actually strip out because they don't feel like net value additive to the planet. You can make money of a lot of things. Taylor Swift makes money. Mumbai Indians makes money. I'm not trying to be holier than thou. But it's a very small percentage of our portfolio. Fundamentally, 30% or 40% of our portfolio will look like, that's not very different from an impact fund. We are happy being this generalist fund with each partner picking and choosing what they love to do. And so that's also our promise to the investors. We say we're not very focused on 1 or 2 sectors. So suddenly in one fund, you'll see a whole lot of manufacturing. In another fund, you'll see more of edtech. And in another fund, you'll see more of fintech.
So how do you assess startups at that early stage? You have no data to go by. How do you price companies and how do you determine what the valuation should be with each subsequent round?
Yeah, valuation is a tricky one. I'll come to that. But it fundamentally boils down to founders, market they're chasing, whether they have capability to scale, whether they've demonstrated some of that before. And I would literally say somebody who's demonstrated the build out of a $100 million company versus somebody who's never done that before. I would almost say I would pay 2 to 3 times valuation for the first, simply on the basis of that. And that's exactly the point. You're baking in probabilities of whether they can build $1 billion business or not. Everything else doesn't matter to me. So that probability is what you're pricing in a nutshell. Not all of them are going to work. There's still a lot of probabilistic elements that will make it fail. You might have picked the opportunity right, but the founder wrong. I'm not playing public markets. I'm playing early stage venture risk. So if money doesn't double every 2 years, what kind of early stage risk are you taking? That's a bare minimum. So if you feel that can't happen, don't either play or price it differently. And if the founder insists that the price has to be different, walk away. There's always going to be another deal which is equally good or better. And so, by the way, you might miss this, it might become $1 billion company. I wish we knew those answers. If everybody knew those answers, why would we play the ones that don't work? Right? So that's how we think about valuation. But fundamentally, I think the big shift in India from 2011 to 24 is anyone who has $100+ million fund cannot envisage a great outcome to be less than $500 million to $1 billion. For that, apart from the little bubble that existed for 2 years in the market, fundamentals suggest that if you want an IPO or an M&A or a secondary exit at that price, then the company has to be between $50 and $100 million of net ARR. So fundamentally goes back to the original question. How do you evaluate? You look at these two and say, can this be that?
Yeah, I spoke with the Dean of Valuation, Aswath Damodaran, last year. There was something very interesting he mentioned. He said that VCs are traders. They are not investors. Is that how you also look at it?
I think at early stage you can't. there's no faking of that paradigm. I think Mr. Damodaran is entirely focused on companies at late stage, right? And a path to public trajectory company. And his opinions would be on WeWork, Uber, Zomato. And there, people do play these funny games. It's no different from the public market bubbles in the last 25, 30 years.
Sure.
So therefore, he's equating them on the inverse path. Like he's inverting the argument in saying they're no different from traders because they're simply trying to ride the price curve and just pump up the price and try to see if they can sell it for a quick profit, which is exactly what traders do. And yes, in boom cycles, it feels that way because the underlying math does not justify the price. I think public markets mentality sometimes seeps into late stage private markets because everyone's looking for a quick flip and a quick turnaround. It's also, by the way, if you notice, the point at which most public market investors by DNA, hedge funds, right, late stage public market investors, they all start walking into private markets. The market is already corrupted for quick returns. And so that's exactly what happened in the 19 to 21 build-up. Despite the hiccup of the pandemic, people thought this was a never-ending thing. And it's also driven by liquidity, so people are willing to take crazier risk.
Sure.
That doesn't affect early stage. It's not like I'll ever have crazy liquidity. I'm a small fund, finite size, finite time period. So I don't play that end of the curve at all. Ironically, I get hurt by that end. I get diluted. I get crushed. I go down the liquidity preference stack. And then if that company goes kaput or gets sold for less, I make zero.
Sure.
Because the lick pref of all these big guys. And so what's happened, you've corrupted the founders to take more and more money and use it more liberally to get growth, which they could have otherwise paced themselves much better and done it close to profitability. So I love Dipinder as a founder. You see his behavior change in the last 2-3 years. The public market said, we don't want that kind of growth. He corrected and turned to profitability. Fascinating, right? So that discipline, it's sad that it has to sometimes wait till a downturn. And in a crazy bull market, everybody looks at each other and behaves badly. The excuse is the other guy is doing it. And so it's a different type of FOMO.
So clearly there is some discipline coming into the market now.
Lot, yeah. Of course, there is a little bit of this bullishness seeping in that, valuations are justified at whatever price. But that's still ironically being fed by public markets, not by private markets, right? And but the two will eventually meet. The funny thing today is public is hotter. All the public stocks are riding at much better multiples than necessarily private markets. Unless it's a hot tech wave like AI or something of that nature. So I think eventually they stabilize. That's why markets are great, right? They're all levelers in the long term. Short term, there will be momentum drivers.
So when it comes to the seed round, the early stage round, what are some trends that you are seeing?
So funnily, I don't think seed has gotten price corrected a lot. So seed capital providers and the risk appetite of what your stop loss can be much lower at seed. Number of seed players have increased. So there's a lot of buzz in seed, but with every 2 years or 3 years, seed resets itself. Because when you see nothing happening, people just vacate the space.
Sure.
Right? Or they write down companies, or they kill companies, or they zeroize them. And then the new set of seed players come. So I think we're going through that very curious phase today where we had a whole bunch of seed players who emerged just before and after the pandemic. They're all fresh and energetic. And we don't know how their performance will be in 25, 26. And then a new set of players will come. Because it's, as I said, it's the easiest part to play. So seed will keep thriving, and it should. In a great entrepreneurial ecosystem, the funnel is always going to be this way. A lot of seed players, whole bunch of players like us sitting one level below, waiting for the best to come. And then a very tight Series A, B bucket, because they're the ones who will determine whether this company has legs to become a large company.
But with late stage funding, we are seeing some sort of scarcity when it comes to funding.
There's a fear. Knowing everything you know that's happened in the last 2-3 years, can you be sure that the next check you write doesn't go through the same cycle? So you're guarding yourself against, I don't want that to happen to me.
Yeah.
I don't want to be the last person giving a check and the company being in trouble, not turning profitable or going bankrupt or running out of cash and nobody funding this outside of it or can't go to the public markets. So any of these look dicey. So scarcity is basically risk aversion. It's not like there's no capital, it's risk aversion. There is a lot more risk appetite for things which are far more stable today.
Yeah.
So primary players till 2 years ago are buying secondary positions. Why? Because it's a proven model and it's profitable. Primary players who were supposed to do Series B and C are buying stuff which is pre-IPO. So they're just shifting themselves on the risk curve because you don't want to risk 20, 30, 40 million on something which looks like these 4, 5 risks are not stripped out entirely. So that's where the market is at. Very tentative, very cautious, and this happens every cycle. I don't know why people don't learn. That's kind of where the late stage investors are stuck. So when a company is reaching a point where you're too small for private equity, you're too stable for venture capital to get excited, and you are close to profitability, you might as well push yourself, get to 4 quarters or 3 quarters of profits and go and stake your luck in public markets.
We are seeing that happen, isn't it? Because more and more startups now want to go the listing route. In fact, there is a focus on growth and profitability versus the focus on growth.
That's what public markets will love you for. If you can hit that balance, not crazy growth. If you can increase your margin line, fantastic. Grow every year by 25, 30, 40%, you'll be a darling of the public markets. It doesn't matter what your scale is. Yeah, your stock might go up and down a little.
But is there juice for retail investors with all the OFS that happens, etc.?
In large companies, they're all greedy. Everyone's trying to optimize the list price. And so you're trying to perfect the price in public markets, not realizing that in public markets also people need to make money. If you strip out all the juice, as you said, what's there to squeeze?
Yeah.
Right? And then the public guy says, you took away all the juice, I have only downside, and you've not protected that either. That's not the stock I want to buy. I'm not saying go and give a ridiculous discount. But when you raise money at a crazy private price, you're tempted to optimize the public.
Do you think the IPOs that we have seen come in from the new age tech space and from the startups, have they been priced right?
No, not all of them. In fact, half of them have been priced ridiculously. As the market shows you, that's my limited point. Eventually, markets rule, no?
Yes.
Who are you trying to fool, right? If you correct those mistakes, they'll reward you as well. So Zomato is a great example. I feel this price optimization is a silly exercise.
Sure.
And I keep telling founders, what's your gain in this, right? You're the one holding the bag. You're the CEO. You have very little to sell. You're not trying to optimize in OFS. Who are you trying to solve for? I mean, if there's a greed, it should be for the company and then for yourself. Why are you trying to solve for everybody else on the cap table who's left the building, right?
Exactly.
And so you have to optimize for your new set of shareholders who have to be with you for the next 5 to 10 years. So if you're doing wrong by them, eventually, karmically, it's going to come and get you, right? And so I feel people will learn.
I think you did something quite path-breaking and unconventional when you decided to come out with a full disclosure of the performance of the first fund. Till now, we've seen venture capital firms be very cryptic about the fund performance. What prompted you to do that? And you've also taken on the responsibility to continue doing this for subsequent funds as well.
That's a scary thought. I sleep knowing that I've taken that responsibility on. I felt like it was the right alignment of incentive for everybody. Investors keep questioning us on whether we know what we're doing. So it's a way to talk to them. Founders, I think, need to know how funds are run. So they're more responsible with our capital, right? And don't think, oh, it's okay, I can be one of the loss items on the Excel sheet.
Yeah.
And team members, right? So we're getting more and more talent into the industry, which is new, but have not seen full cycles. They've only heard this hype about unicorns.
Yeah.
But how does it actually materially transform to returns is something that they know vaguely, and I can go and teach them all internally, or I can say, I'm open to sharing that with the whole world. People think it's about marketing. It's not about that. It's about essentially being accountable as if you were a public company yourself. So if I'm preaching and professing to my founders, you have to be capable of public scrutiny, you have to share your numbers quarterly. I can't be shying away from all, right? So I'm not saying I'll do this on a yearly basis because it leaves a very skewed impression, and that's confidential as well. Once a fund is done, I actually don't see any harm in revealing it. Because the people who are going to judge you are the LPs who give you money.
Yeah.
So if you feel you had courage to go pitch for another fund, which I plan to do later this year, then what am I shying away from? I also feel like Indian funds in an Indian environment had their own sets of challenges.
Yeah.
Growing up from zero. And it's not the same as the foreign brands which had hundreds of millions of dollars on day one. They may or may not disclose, but I felt like the Indian industry can learn a lot by beginning to accept that this is the right way to build. Why borrow everything from the valley, which is from the 70s or 80s as accepted practices? So it was to turn things on its head. But as you said, it's scary as hell because I knew Fund 1 when I published it. But now once I've done it, you can't shy away from not sharing Fund 2, Fund 3, etc.
Granular data that you shared in that report, it shows that 17 of your 78 portfolio companies generated about 98% of the total gross returns. That's taking Pareto principle to a totally different level.
That's correct. If you look at data collected in the West, it shows that venture has consistently shown that the top 5, 6, 7 companies in a fund will return 80-90% of the capital, right? Mine happened to be a little bit more fragmented because I built a wider base of companies in a very different era. It exactly might play out that way in funds 2, 3, and 4, right? It's not going to be easy to beat conventional wisdom. India could be a little different, but Fund 1 didn't prove that for sure. And I think that's the nature of the game.
So how do you decide how to distribute capital?
I think in seed, you rarely know this. You will take an established team where you have a lot of faith on the market opportunity and double the size of the bet. Instead of playing 2 million, you would play 4, 5 million.
All right.
It's a manifestation of your confidence that I think this team has a better chance of building the billion-dollar business versus this team. I like both, but I'm willing to double the capital bet on the second team, right? That's one way. And then, as we've grown in fund size, we don't keep all of this capital for that early risk. We're keeping more and more for later risk. Because you know you'll get these things wrong. And history has shown that that's the nature of venture capital. So I think you don't go and bet the house on a particular company. You watch it through the various stages and ideally double down as the company goes deeper and does better and better. By the way, there are funds in the West, from what I hear, which won't do anything after seed. They don't keep reserves. So they just spread their bets a long way. Like even a Y Combinator started an opportunity fund and then derailed the effort. Because they said the incentives are not aligned, there's signaling risk, etc. And they only do that opening check now. They don't do a follow-on check. It works for an accelerator. It might work for a fund which has no intent to sit with the founder after 6 months to a year. We've discovered at Blume, we like sitting with the founder till the IPO baton is passed, right? And that's our DNA. So we should plan for a fund which allows us to continue playing into the best companies.
So Fund 5 will be bigger?
About the same size, because I think that's enough for seed, Series A, Series B.
If you look at two of your portfolio companies like Unacademy and Slice, now Unacademy is a unicorn. It's still a loss-making company and that sector is clouded with some sort of uncertainty, some sort of pessimism. How do you treat these portfolio companies?
No, so two things. Let's take a step back. My ability to influence them is very little. They're already past 6 to 8 rounds of funding, right? So somebody else controls their fate far more than I can. I can give advice and hopefully it's good and they'll take it. But beyond that, I don't control capital. That said, my confidence plays out on other investors who might want to be investing in that company. So that's why we've seen value in knowing the company intimately, sitting on the board. I'm not on Unacademy, but Ashish is on Slice. So people still call him and say, what's going on? Is the company going to get to profitability? So you have to have that faith. You can't fake it. Now, what we are measuring at any point of time is the same as the other 8 people or 6 people in the cap table are. To see that the capital in the bank can take this company closer and closer to profitability. And will the valuation hold? It's not material in this market anymore. That's like saying I bought a stock at 100 rupees and it's fallen to 80, so it's a bad company. No, that's not the right way to think about it. At 80, does he have enough money to be able to build the business back so that the stock goes to 150, right? And that's how I'm viewing all of this risk.
Unacademy did say that they have a runway to last
massive
18 months. And
he was very clever. He was one of the largest last rounds that the market allowed. And he didn't allow for us to take a single dollar of secondary out. He took it all into the company bank account. And so, therefore, he has enough of a cushion. So despite, he was quick to course correct, lay off people, cut costs, extend runway. So yes, he's not yet at profitability, but he has the best shot at getting there because he has a few $100 million in the bank. right? Slice didn't have that kind of capital, but he knows that's his only playbook. He can't ever risk bankruptcy.
There's a lot of regulatory uncertainty, though.
There was a different set of problems. It was not around edtech per se, but it set him back. But he had enough also in the bank to stay alive and grow slowly. Of course, he needs more money to grow faster because now you almost become a bank, right? And so you can't grow at a different pace unless you have growth capital, which he'll hopefully get later this year.
And you'll be there till the IPO.
Ideally, yeah. So that's our dream, that we are relevant to the founder and the company till the IPO. And here's another interesting aspect for you, that our investors are now coming into the companies. And one of the many reasons that drives them to come in is because we're still there.
Sure.
We're still able to vouch. We're still on the board. If we had left the building, they're going to say, why should I play that?
I find it very interesting that you say this because in 2017, when the entire ecosystem was going through a rough patch, you said that one of the lessons for you from that time was not to give up on the founder till the founder gives up.
Yeah.
What do you mean by that? And when you put this alongside the fact that 50% of the portfolio companies in Fund 1 did not generate any returns.
It's a good question. I think we've tried to become less emotional about it. So we're not like foolish in terms of amount of time or effort spent on companies that are struggling. I'll be blunt. You have a finite time in your day and week.
Yes.
And so you have to balance that out. So ironically, the winners sometimes require much less time, right? The struggling ones ask more of your time in helping them capital raise, in helping them think through strategy, helping them find people. Why? Because they're not flush with money. Money solves a lot of the problems I just said.
Yeah.
But they haven't gotten the money. So they're struggling. They're asking you for more and more help. But basically, I think we've been shrinking the time window, to be honest. Earlier in Fund 1, for 4 years, you didn't have a new portfolio, right? In Fund 2, you added another 45 companies. So a new portfolio. You're answerable to a new set of investors who are not the same as the Fund 1 investors. So now you have to divide up your time between Fund 1 and Fund 2. So slowly the Fund 1 folks don't get orphaned, but they get lesser treatment if they're not breaking out. It's a time calibration. So to put it, so there are two parts to your question. One is, how do you balance that? With every cycle, I think we're a little harsher. If you're not breaking out in 3 to 4 years, they will say, look, we appreciate your entrepreneurship. We'll talk once a quarter, but I can't move heaven and earth for you, right? Because the guy next door has broken out. He's going to pay the big bucks for me. I have to help them get even bigger. It's a power law business. I need to ensure that he or she can build a multi-billion-dollar business. The good news is, when there are multiple investors, even that load reduces a little on you. The other one is philosophical. So the best analogy I have for that is a remark from 5-6 years ago, where one of my new team members, youngsters, came and said, these companies, 4 or 6 or 10 of them are useless. Why do we even have them on the wall? It's embarrassing to talk about them. Yeah, they're in the portfolio, but we mark down aggressively. If there's no round in a company for 2-3 years, it's marked at 0.
Okay.
Because we don't know whether we'll ever make money off that. Why are they on the wall? I said, as long as the guy or girl is coming to work every day, working their backside off to try and make something out of it, they stay on the wall. The day they give up, we shutter it down. As long as they're at it trying to build more value for you, you just watch their back. That's all. So you can say, what role do you have to play in them? You can't give them capital. It's untrue. I can still influence a big investor to come and put $30 million in the company. So that's what we've realized our power is. We have managed to raise more than 50% of a round in a company which raised $60-70 million, where 2 other big marquee firms were sitting on the cap table and they didn't bring any dollars in.
Sure.
Right? So we can influence outcomes. And only because we know we can do that, we are at it. We just keep pushing the envelope.
Digital native brands have really taken off. Quick commerce looks very promising. There are only 3 big players in that space now. Do you think that these 2 areas will have significant opportunities going forward? What are some areas that look exciting to you?
So I think the 2 ends of a consumer spectrum that you raised, which are interesting but not a very big part of our portfolio construction. I would say combined everything that you described, retail, new age commerce of any kind, brands, is probably 10-15% of our portfolio. We're big believers in cross-border software as an opportunity. It's only again 20-25% of the thing. Do we believe financial services are all going to go digital and go scalable? Right?
So fintech.
Fintech is another 20-25%. And all of these marketplaces, brands, edtech, agri, everything else about the India opportunity is the final 30-odd%. So this is kind of how Blume looks at it, equally bullish on all the segments. When you break it up in that way and you look at it for a 3-year vintage, you're essentially talking about 8 to 10 investments per bucket. I don't think that's super difficult. Thankfully, we're getting phenomenal flow. And to find 2-3 a year, we are talking about. That's not, I think, that difficult to find.
What's the next breakout star from your portfolio?
Currently in Fund 4, one of the companies taking off is Battery Smart. They're a dominant player in that space. Yeah. Got in early, executing like a beast. Both founders are amazing. Getting more and more capital to grow faster and faster. And it's capital intensive after a point. It's not a conventional venture model in that sense, but we got in very early. So people ask us in these capital intensive models, what's your role as an early player? If you get in very early, you can build enough of a stake and now play pro rata. Sure. So whenever the next round happens, there will be a 4th check into the company in 2.5 years, right? So that's a fast one. But then hopefully, if next year you ask me this question, I'll have 5 more from Fund 4. But I think, yeah, we feel good about all our vintages so far. And yeah, the rest will unfold in Omega files, 2 to 10. So we'll be chatting about this for a decade. Yes.
Thank you so much for your time, Karthik.
Thanks, Neha.